Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 188. In the last episode, I asked you, what is it that you want from these episodes? Do you want more stock market reviews and recaps, or would you prefer a little more lessons? And many people said lessons. They want to learn more and broaden their knowledge. So that's what I'm going to do for you today, is share with you some insights of doing an iron condor, the basics of an iron condor, and why you may want to set one up. And we'll go ahead and set one up on a stock. Because we're going to also launch and release the Iron Condor course here coming up soon. So that's what I want to do, is share with you kind of some insight. If you aren't trading options yet, this might give you some perspective on why you may want to look into learning about options, and really the whole key behind the basics of kind of the advantages and disadvantages to trading these option strategies, especially iron condors. Now, there's a lot of option strategies out there. We're going to hone in and focus on iron condors here over the next month. We've already done a handful of things on verticals because we do have the vertical course out already. And if you don't have that one and you want to get it, I would highly recommend you go for it before trading iron condors. You can get that at our website at rise2 and learn. So anyways, with that in mind, let's take a look at a couple of quick stocks and choose an iron condor and look to create an iron condor and why we may do this iron condor. So when we go ahead and look at a couple of handful of stocks, you typically want to trade options on stocks that are, $50, $60, $80 or more. That's just because you have many more strike prices there that you can play with. Apple's a very popular one. It's very liquid. Having a liquid stock to trading options with would be helpful. Anything like Apple, Tesla, Netflix, they all will do just fine for trading and options. If you look for a very small stock, like a penny stock, usually will not work out well to trading an option contract on them or an iron condor. So in our case, let's just say you're looking to put on an iron condor. First off, why would you put on an iron condor? Well, an iron condor is a nice situation where you don't expect that stock price to move that much. And what it does is really it sets up a price box or a bracket. Let's just say I'm looking at Apple right here. And you can see we've had this huge move or spike up in prices recently, and now we're just kind of isolating slowly. So it might be a nice time to do an iron condor. You could do it when the VIX or the volatility is higher because you can get wider and get more premium. You could still do it lower, but you might do it maybe a little bit differently. So what you're trying to do is really box in this strategy, and an iron condor really sets you up for making money from the upside and the downside, and you let time decay work in your favor. You see, when you buy a stock, which absolutely there's nothing wrong with buying stocks, but when you buy a stock, you only make money when that stock goes up. With an iron condor, when you create this strategy, and I'm going to show you right here, it's going to look something like this. That stock can go up, that stock can go down, as long as it stays in this range that you define and that you choose, then you make money. And you make money every single day, and that continues to ramp up. So think about that for a minute. You make money as that stock moves up, or the stock moves down, or it moves sideways. The time that you lose money, here's the risk, the caveat, is if it moves outside of your defined range, okay, within your time period. So you need it to stay within your range. That's the key, is can you choose a range for a stock? Can you choose that, hey, it's not going to go beyond this and it's not going to go below that? That's really the key to iron condors, is choosing that range. Now you could make it a little more weight on the downside, a little more weight on the upside, meaning more risk, or you think it's a little more bullish. You could do it that way. There's nothing wrong with that. And it's just creating an unbalanced iron condor. But really, the simple approach is you're choosing a range. With a stock, you need it to go up for you to make money. So here's what we'll do. Let's take a look at setting up an iron condor with Apple. I'll just show you here this example. And you might want to do this here, let's just say 40 to 60, could be 80 days out. You could even go a little bit longer. And you're looking at the premium here. So when we look at some of the strike prices here, and let's just look at a 2-day kind of chart, because I could see, okay, well, I don't think this stock will get to maybe 200 because it's already fairly stretched. And I think 170, 175 might be a nice range, okay, so for the bottom, because we know stocks fall faster than they go up. And with the Fed just now raising interest rates a little bit, we could have a slight little pullback. We've had a lot of green days. So I need to be very careful for this downside area, and I might do a little tighter there on the top side area or above. So what I do in order to create this iron condor is we're going to sell call verticals and we're going to sell put verticals. Now, if you don't understand what those are, I highly recommend you look at just some basic option videos that I have available, or take a look at the Options Foundation course to get some insight. But basically what you do is when you buy a call, okay, let's just say we buy a call, and most people understand this, stocks, you look for that stock to kind of go to the upside, okay? Now, what we do is we go ahead and hedge this, and let's just say you sell a single call further out, okay? You analyze the trade, and now this creates a vertical, okay? Now, in this case, we're buying a vertical. Let's just say I do the opposite of this, okay? So now I'll go ahead and sell this one, and I'll buy that one. Well, that gives me a whole flipped profit picture. So what did I really do? Okay, well, now what I'm doing is I'm selling the 210, which basically gives me a naked option. Okay, so the whole strategy behind selling iron condors is you're selling at the 210. So basically, if you had a stock and you're selling calls on it, this is what you're doing, is that when it gets to 210, you lose your stock. In this case, since we don't have stock and you don't need stock to trade iron condors, you go ahead and you buy that additional vertical for protection, because what if it goes against you? Okay, so basically think of it as you're playing that downside move when you're selling a call vertical. So let me go ahead and now position this as an individual kind of vertical on its own, or batch together. So we'll go ahead and analyze, and there you can see the 210, 215 will make 50 cents, or in other words, $50 at expiration, and we're risking about 450 for the trade. So you make 50 on 450. If I did two of these, you make 100 on about 1,000. So about 9% there on your money, maybe 10, 11%. You're making a little bit more there. So when you look at now boxing this in, well, right here we make money. If you look at this profit picture, here's our strike prices, here is our profit and loss, and here's our zero line. So with time, this white line, which is the current or today line, gets closer to the green line. So as I go ahead and let's just stretch this out a little bit. With time, as I move time forward, you can see that white line gets closer and closer, which is our theta decay. So that white line decays, and which means we get into profitable territory right there, $26, if that stock doesn't move. Now, if it goes up, let's just say it goes up to 200 tomorrow, we're down about $140. Okay, if it goes down to 170, okay, we're up about $92. Can I take it off in 1 or 2 days? Yeah, absolutely. Now, here's the issue with this. Well, if the stock doesn't move, you make money. If it moves down, you make money. If it moves up, you make money. But if it gets to 210, you're kind of losing quite a bit, about $200-300. So you still, make money, but you gotta make sure it stays under that 210. So one of the ways to combat this is to sell a vertical, which is creating our iron condor. Let's just say around the 165 level right here. We'll go 165. So we'll sell this vertical, analyze the trade, and this one, the way you make money is if it stays above 165. Remember, we talked about boxing it in. So this one you make, again, let's just say, let's go to 170. The premium's a little weak there. So you make about 38 cents on this one. So here you need it to go up, you make money, go down, you make money up until that 170. So you make money if it stands still, goes up, and goes down up until 170. So basically, combining these together allows you to create this box effect. Okay, it boxes in that stock from 170 to about 210. And you make about $2.70 every single day that stock stands still. Now, as time moves forward, you can see right here, this continues to move up and up and up and up with time. Now, volatility can be a problem because you are short Vega. So if volatility spikes, meaning stocks go down, you lose money, and this can be a problem. So oftentimes what people recommend is you go a little wider, let's just say, on that downside to give you a little more room, or in other words, have a little extra negative delta when you have negative Vega. So you could create something like this. Now you could create a little unbalanced. Let's just say you are bullish overall on the stock, but you're worried about it going down. Well, I could say, well, I'll go ahead and put 3 puts to 2 calls, meaning I'm a little more bullish, right? I could say, okay, well, let's do 6 to 2. Well, now you can see I've stacked more risk on the left side, okay, and a lot less risk here on the right side, meaning we have less calls than we do puts, and we're selling. So if you want a balanced approach, though, let's just say you're not sure where the stock's going, or you're kind of a little bullish, you want to be a little neutral, you could create a position like this, 2 or 3 or 2 to 2, and now you're selling 2 puts, you're selling 2 calls, and you got a vertical set up right here where you're making $146 on your investment of $854. So again, about 10%, give or take. And this, of course, will depend on if you take it to expiration, because what you could do is, let's just say this goes for a couple of weeks, somewhere between this price range, and you take it off and you can collect $60, $80. Could you do that? Absolutely. There's nothing wrong with that as well. So let's go ahead and bump up these contracts to about 5 here and about 5 here. And now as we go in this iron condor right here in this setup, take a look right here. What's going to happen is right here, you'll make $360 on $2,000 investment. So that's about a lot better. Whereas if you go ahead and buy that stock to make $200, I mean, this stock, how much money do you have to put in if you're paying $190 a share? How many shares can you really get? On $2,000, 191. Let's take out a calculator here. Let's go $2,100, 191. You can get about 10, 11 shares. Let's just say 11 shares. So 11 shares for you to make, let's say $300. Okay, where are we? $360. $360 on 11 shares. That stock needs to go up about 32 points, right? So 32 points times 11 shares, that's where you'll make that money. So 32 points on that would give it about, it's got to go pretty high here. So we'll go and take a look. You'll be at about 223. So it's a pretty big move. Whereas here, no matter what, as long as it stays between this range of 165 and 210, you make your $360 at expiration on August. So that is about 64 days out. Okay. And the way you just put this in is I could put these in as separate orders right here, send that order in, and I could go ahead and send this order in. You could do it as one order. For example, putting it in as an iron condor, and there we go. And now we're in that position, and you can see we're moving here left and right. Now you'll start out a little bit negative just due to the bid-ask spread, but that's how an iron condor works, is really we have these now positions right there. Whereas if that stock continues moving a little higher, we're still okay. Because remember, in 1 or 2 days, if that gets a nasty drop, you'll be back to kind of normal. So this is what happens. This is how iron condors work, is now I've boxed in kind of this trade, and as long as it stays between this range of 170, 165 really, and 210 at expiration, I make my full amount of capital. Now with time, let's just say in a few days, here's my theta. Every day I make about $6. But as that time frame continues moving forward, that continues to accelerate. Because remember, 30 days out compared to 20 days out compared to 10 days out, that time decay curve continues to accelerate faster and faster. So I hope that makes sense on how an iron condor really works and the basic setup of it and why you may want to do that. You can do this on really stocks that are moving sideways like Apple right now, or that have had a long explosion. You could say, look at Netflix, right? You could say, well, maybe the steam is running out. You could create an iron condor on this. you know, and position it a little more, let's just say bullish. You could wait like 6 puts to 1 or 2 calls because, hey, it continues to move up and up and up. You could do it more bearish where you're saying, hey, well, the run is going to be over soon. So you could say 6 calls to 1 put, and you could create a setup kind of like that. So the flexibility of it is really amazing depending on what you're trying to do. And you can see that with time, this white line will just continue to get closer and closer to that green line, and that's where you make your money. And you don't need to own the stock. You don't have to know the direction the stock is going. You just have to know a range. You could take it off early if you want, or you could let it expire if you want. Now, the issue, of course, is if it gets outside this range, well, you can lose your full investment. So can you take it off early if you see it getting into a negative $700 loss? Absolutely, you could do that, and then you'll take your loss. Whereas with a stock, of course, you get to keep that stock, and you can just kind of hold on to it. With an option, you know, eventually there is an expiration date, and that's where the problem can lie. So other than that, you have a lot of other advantages, whereas if that price just wiggles, hangs around, and you don't know the direction, you know, on stocks, even like a Tesla, where you have this long explosion, it makes more sense to do something like an iron condor than buy the stock way up here, because this explosion is already up about 20%. So I wouldn't want to chase it way up here. Instead, I'd rather do an iron condor and say, hey, well, maybe it continues, and if not, if it pulls back a little bit and gets back into 323, well, I'll still be okay because I make money from the time decay. So anyways, I hope this was helpful, and you learned quite a bit from iron condors. If you want to continue learning with me, go ahead, subscribe to the YouTube channel, or get on the newsletter list by clicking this link right here. That's where I'm going to send out the news and alerts as we release the option course for iron condors. We're getting ready to ramp up some of these things. I'll show you the insides of you know, my file structure there with all the videos inside of them. I'll send you a little discount bonuses for that as well, and a lot of other iron condor training lessons that go along with it. And of course, if you're on the newsletter list, if you're subscribed on YouTube, you'll get that announcement for this soft launch coming up soon. And then what we're going to do is actually we'll close down the course, and then we'll reopen it later on in the fall. So that's kind of the way I'm going to approach this, because I want to make sure the course is good. We'll get the feedback from people that watch the course. If we need to make tweaks over the summertime in August, maybe even September, we'll do that, add in an extra module if that's what it takes. If the course is good enough, then we'll open it back up in the fall there, so that way you could get access to it again. Anyways, thank you so much for joining me. Hope you enjoyed this lesson. Be sure to subscribe on YouTube or get on the newsletter list, and I'll see you next time.